populations of those countries that have funded the research. And it's a very limited number of countries. It's two or three or four countries that actually are on the path of having a vaccines for the populations. And that's in the context where the manufacturing capacity, the global manufacturing capacity, uh, is not existing only in those countries like the US or Europe, but there is a vast untapped manufacturing capacity in emerging economies. And in particular thinking about India. So, what do we do now in such a way that not only those innovators are fulfilling their obligations with the US governments or the
What's up,
European
everybody?
governments, but in addition to
Marcus
let them
opens
access
in 8 minutes.
manufacturing capacity of
I'm excited
emerging
to see what's going to
economies
happen.
on principles of fairness and equitable access. And I think this is a challenge, but I think
I'm
the
excited
two
to see what's going to happen.
are opportunities that can be
I
combined.
probably would
Like
take some profits off the
manufacture
table. I don't know. We're going to
400
see.
million doses of vaccine under the to those
Pre-market looks
governments,
real
but in
good.
addition, let those innovators
Well, at least for some
access
of my stocks.
manufacturing
Most of my stocks,
capacities
I should say.
in developing countries that can, in turn, serve the need to access of the broader population.
And this, of course, depends on those timelines we've been talking about. Like I said, at least some sort of indication by this year. But what are the realities? Do you think on any number of them getting to production and distribution before the end of the year?
Well, I'm looking at what those pharmaceutical companies are publishing in
I'm
terms
going to go
of
ahead and take some profits off the
key
table on some of
drivers
my stocks, like
on
American Airlines. We're going to
a
see.
number of
If it comes
vaccines
back
are
up and tap this
created,
number again, $23, I
meaning
might
that
just
they
take
are being
profit
tested for
and
efficacy.
re-enter. I don't know. We'll
We don't
see. I
know
might
if
keep it for the
they
long run, or I might take
harm
profit.
people because they went through a phase one that is about controlling the doses
I
and
kind of want to just
assessing
take
the
profit and then
efficacy.
reposition later.
Now, if we got good
I
results
don't want
from
to get too
phase two
greedy.
about efficacy, I think this is possible that with a lot of parallel tracking in the clinical pathway, we can
The
get
thing
some good
is,
news before the end of the year.
there's really no so. Well,
And
let me
we see
see. I'm gonna
companies like
change this up a little bit.
AstraZeneca
I'm gonna show the 3-year
making
charts.
a very, very clear
Oh
announcement
wow,
that
that
they
doesn't
are
help.
ready with
That
the
doesn't
first
help at
doses
all.
of
Let's go to
vaccines
the 10-year chart.
before the end of the year.
All right, we're going to leave it there. Arnaud Bernard, head of healthcare at the World Economic Forum. Thanks so much for being with us today.
Thank you very much.
And stay with us. We're getting closer to the opening bell here on the first trade. We'll be back with stocks right after this.
Y'all ready to see these numbers move around? Hmm. 5 minutes, baby. Let's do it.
Looks like we're in for an early rally on Wall Street this Monday morning. Dow futures higher across the board. Let's check in with Jared Blickery. And Jared, I know NASDAQ futures were down earlier, but they've since come into the green.
Yeah, that's right, Alexis. Kind of seeing a trend that's been in place over the last couple of weeks, and that is that tech stocks have lagged, along with biotech for the most part, and financials, industrials, energy, those have all been leading. So we're looking at Dow futures up about 0.8% here, about 239 points. And we're also seeing some rallies across the world. Asia had a pretty nice gains. Travel stocks leading the way in Europe and also in the US. And let's take a look, just kind of looking back over the last 15 days, because that's when this rally began. And if we load this here, actually 16 days, we can see the performance in the NASDAQ 100. These travel stocks really catching a bid. United is up 104%. And again, that's over 16 days when the most recent leg of this rally started. Also, Expedia up 50%. And some of the other stocks doing well, financials. So let's take a look at the Dow here, and we can see JP Morgan, for instance, up 32%. Now, with the yield curve expanding the way it has, putting a little bit of a headwind for growth stocks right now.
All right. Thanks a lot, Jared. I do want to mention oil very quickly here. It is down more than 1% to $39 a barrel. OPEC Plus extending its production cuts to July. Stay with us. We've got the opening bell coming up next here on Wall Street. We'll be back with more of the first trade right after this.
I thought it was. Yo, what's up, bro? What's up, man? Just looking, man. I'm gonna take some profits in a bit. We're gonna see how this thing works out. Time to start snatching money off the table. Which company? I don't know, but I think I might snatch off American Airline. As you can see, on Friday, it closed right here, and that put me at 54.67% profit. But it's gonna open up at like $1 higher or $2, near $2 higher. So that's gonna be like a big jump. I might snatch profits when it come up here. I think that's what I'm gonna do. I think it's gonna run up here, and I think I might just take profits. And I don't want to get greedy. I mean, I could keep it for the long run, but I think I might just take profits and hop into a different trade, or either wait till it pull back. I don't know yet, man. I'm still gonna see. It's gonna open up in like 22 seconds, 21 seconds. Because that's a real big jump. Just wait. The market's about to open in 10 seconds, and this little percentage of profit is gonna change. Like right now, based off Friday, I was 54%. Watch this. How much percent is it not going to change?
Stocks are ready to add to last week's rally. Big week also. We've got the Federal Reserve meeting happening Tuesday and Wednesday.
All right,
here's the opening bell on Wall Street.
I think it changes like every 30 seconds or so. Yeah, see, I'm 65% up.
And there we have it, a new trading day and trading week underway on Wall Street. Nice, powerful rally for Dow futures heading into this session, but the NASDAQ has been seesawing heading into the session and was just down slightly. But here we have the Dow up 130 points to start this Monday morning. We are joined by Keith Bliss, CEO of IQ Capital, along with Jared Blickery and Brian Sazi. Good morning to you all, guys. Keith, I'm going to start with you. Just an incredible rally on Wall Street, despite all of the seemingly bad news, the civil unrest, a continued climb in coronavirus cases. Would you say that we are in a new bull market, Keith?
Well, I'm not so sure we ever left the bull market, Alexis. Remember, you'll have declines in secular bull markets throughout history. We've seen that, so I think that's what we started to see a little bit in March, and rightly so. I mean, we'd hit all-time highs in the indexes, with the exception of the Russell 2000 in February, and then of course we got hit with this pandemic crisis. So the sell-off was pretty severe and extreme. And one of the things that definitely in right now, not leaving the bull market, but we're definitely in right now, is a very strong trend upward. The breadth in the market has just been stunning since the middle of May. If you look at the New York Stock Exchange advanced decline line, it has had 10 straight sessions where advancers have outpaced decliners 2-1. And in fact, on Friday, we hit another new all-time high. If you look at the advanced decline line, which was last hit, the other all-time high was in February of this year. So it's definitely been a V-shaped move in the markets, if not a V-shaped recovery.
I'm gonna go
So
check my route hub. Yeah, back.
is
All right.
working here. The breadth is still very strong. Will remain strong probably with today's trade. And I would not be shorting or selling in this market right now. I'd continue to stay long and maybe even adding in.
Keith, interesting on that front. Wall Street Journal poll making a lot of news this morning. 80% of the people in the country think it's out of control. The country is out of control, yet we have the market continuing to rip to new highs. Bank stocks on fire, travel stocks on fire, you name it. NASDAQ not so much, but most of the market on fire. How long can a rally continue like this, even though people on the ground are saying that the country's out of control?
Yeah, we're experiencing the most extreme instance of cognitive dissonance, right, Brian? When you take a look at the world, and I would probably be in that number, that 80%, if somebody were to ask me. I mean, what you look out your window, and what I try to do is old-fashioned look out the window financial analysis. What you see is not something that you should like, and I won't get into all the social issues here, but. Again, the market has built this breadth.
I kind of want to sell this.
Institutional investors, if not retail
This
investors,
HP.
I think it's now
It's at a good spot to sell too.
Until we start to see some money being taken off the table, either in the forms of starting to play with house money. But right now, our breadth indicators are so very strong. I don't think the nightly
I'm selling it.
what
Let's do it.
Are looking at, or what they may say in the surveys, are going to impact this market at all. It will continue to.
But that's
higher.
also my dividend play, though. Let me double check. Make sure I'm doing this
capital
right.
goes where capital gets rewarded, and even if you're a little bit late to the trade, I think you can still get some reward in the equity markets in the U.S. And that's why we'll continue to see capital flows going there.
And Keith, what's driving this trade? Is this investors betting that, well, let's say by mid 2021, earnings for the S&P 500 will be back to pre-COVID levels? Just trying to understand that it can't just be all Fed stimulus driving this rally.
Well, it's not all Fed stimulus. You're absolutely right, Brian. So remember that the equity markets are what participants try to value the market as is the discounted cash flows on a future stream of earnings 12 months out. So you're absolutely right.
Go ahead and take that off the table.
That a lot of the COVID pandemic crisis will be out of the way. Perhaps much, if not all, of the social.
I don't know. I just feel like that's going to pull back, man. I ain't trying to get caught.
Business, but I think
you know what I mean? Like, gotta get that off the table real quick. I ain't trying to get caught. Let's see what this one look like.
Can attest was very surprising.
AT&T
calculation variances that they may have to go back and readjust later on. Let me see. But when you take a look at even. We had that large population.
I'm gonna keep AT&T. That's my dividend play right there.
And the larger
I ain't gonna mess with that.
Are just now starting to come back online, like New York,
Bank of America. Let's see.
Boston. So if we factor that in later in 2020, then
it's decent dividends. I ain't too serious.
Start to assume at least a very strong rebound recovery. I don't agree with the V-shaped recovery. We never see those unless they're manipulated. But I do think that people are starting to try to get ahead of this trade, that we will get back to all-time highs that we experienced in February. That's why they're pouring money in now.
Yeah, speaking of all-time highs, Keith, we saw the NASDAQ hit an intraday record high on Friday. What do you make of the run-up we've seen, particularly in tech stocks? Valuations there getting pretty frothy. You said earlier you wouldn't be taking any money off the table right now in this market, but what would you be doing with tech right now that seems to be just so high-flying?
Yeah, believe it or not, I mean, even though it hit the intraday high on Friday, we still don't have any of the major indexes, including the NASDAQ or the NASDAQ 100, in an overbought position. And even if it was overbought, again, I get back to one of the other indicators, strong indicators that we look at is that advanced decline line, the breadth in the market. and therefore I would not be selling any of those names. I think you're seeing a little bit of a sideways move on those tech names right now because people are concerned that they've gotten ahead of
Ooh, the
themselves.
dividends on this one is nice.
Off the table, and
I
also
might
back
keep
to my
that.
earlier point, if the economy starts to come back in a
I
great
got
way,
some in
the
OAS.
stay-at-home
Hold
trade
on, I'll
starts
take a
to
look
fade
at
a
it.
little bit, and people will start putting money back.
Give me 1 second. I'm just making sure I'm good.
Financials like industrials, which Jared mentioned, which we did get to an overbought signal last week. So therefore, with tech, I would still stay long these. You take a look at a company like Apple, which is everybody's favorite stock, it seems, has just continued to run up. They've benefited a little bit about what we've been doing the last 3 months, both here and globally. And those names will continue to perform. The other thing that I think you see the run up in tech is that a lot of the tech names, most especially Apple, have incredible balance sheets that have allowed them to weather the storm. And if we think the storm is now coming to an end sometime soon, then they will be the real winners out there and will likely be able to grow their businesses through acquisition strategies, if not, what they're doing on the organic front. So that's where tech stands for me. We'll see a little rotation out and get back in more traditional sectors, but it's still going to be the sector at play, along with healthcare, going forward in 2020.
Yeah, you mentioned Apple hit a record high, by the way, on Friday. Everybody, let's check in with Jared now for an early look at what's moving us higher this morning. Jared.
Yeah, we're looking at the NASDAQ here. We can see those big cap tech stocks really kind of underperforming again. We're in line with our analysis. Amazon is up 1% here in the pre-market, up 36% year to date. But I've been talking about the last 16 days. It's actually 17 now that we have this rally underway. And let's just take a look at some of our leaders here and some of the losers. Now we see a lot of the early movers into the COVID trade, like Netflix. That's down 5% in this rally. Year to date, still up 25%, but we are seeing this rotation into industrials and financials. And really, Boeing is a standout example. We can see Boeing is up 82% over the last 17 days, up another.
All right, you said OAS. What'd you get in at?
It's still down 33% or 32% year to date. And just mentioning the yield curve again, that is
I hope you didn't buy like up here.
70 basis points, 50 basis points, and a lot of similarities to 2009. In March of that year, we had Bazooka QE1, and in March of this year, we had a major. I wouldn't even call it Bazooka QE1 because it's much bigger. But just kind of taking a look at the year to date here, we are marching towards those highs, and we've cleared a number of important resistance levels. The last one is about 27,000 in the Dow. In the S&P 500, we can see it has cleared resistance, and not a lot in the way between now and the all-time highs of about 3,400. And just taking a look over the last 15 years, we can see, and to Keith's earlier point, that really is this bull market.
Check Friday or Thursday.
Bear market. Now we dipped below this trend channel we have here, but for the most part, the megaphone pattern.
Thursday, Friday, what price you get in at?
A decade or longer is still very much in play here.
That's a big jump.
Keith, at least in my circles on the street, strategists are starting to get worried about political risk. I'm starting to hear murmurs and some concerns. No big positioning yet based on what may happen in the election, but still the concerns are starting to rise. How big a risk? And the main risk seems to be higher taxes under a potential President Joe Biden. How big a risk is a Biden presidency to the markets? And when do you think that starts to get priced in? You're seeing most polls, Biden leading Trump here.
You can't remember.
Yeah, so I don't think
Gotcha,
we see
gotcha.
that get priced in until we.
Yeah, you don't want to buy at the top because usually when you buy at the top, everybody's selling. So you basically it's gonna come down, you know. Like American Airline, I got in on this green dotted line right here.
Voters can really.
That's how I got in right before it shoot up like that. So I'm trying to see where I'm gonna take my profits at. I'm thinking about taking it right here.
We'll start to see how that shakes out and who's leading in the polls.
That's only one bar though, so I don't know. We'll see.
Want to underscore your point.
But I'm thinking about just taking it right here and then when it pull back.
On the surface right now with some of the policy proposals that have been floated out there, either by himself or some on his team, about higher taxes, stronger regulation, money being spent more on infrastructure, which would be a good thing in my opinion. But moving the capital and the liquidity into different parts of the economy as opposed to deregulation.
See, this one I need to just take, you know.
And the like. I also question, I think we need to ask the questions in a Biden presidency, what happens with this manufacturing renaissance that we've started to enjoy over the last 3 years? Maybe that still continues apace given the problems that we've now identified with China having most of the manufacturing, for example, and 80% of our pharmaceuticals. But there are stark differences between the two candidates. I don't think we'll see that shake out until we get into the middle of
You making money though, bro?
And I'll tell
That's all that matters,
one of the
man.
most important dates on the trading calendar that you can put out there is August 3rd. And August 3rd is the date that you should mark where the S&P 500 closes. Because one of the greatest indicators of who will be elected president is the
Verizon looking good.
S&P 500.
Yeah, I got in right here on this.
90 days before the presidential election.
The green dotted line at the bottom. That's why I got in.
90 days.
So about let's see
is
what I
higher
get
than
in
it was
there.
90 days before. Then generally the
I got it right here.
president retains the White House.
I'm still riding.
Then the incumbent or
I might keep it or I might just take out right here. I ain't know yet. We're gonna see.
The last time the S&P
we're gonna
500
see.
was lower 90 days than it was 90 days prior to that was in 2016, and Donald Trump became your president. So again, those indicators, what we see going on inside of the economy, will there be that rebound? All these things I think will start to drive people to who will win the White House, and therefore they will start to set up their trade at that point in time. And you're right, there is some risk, I think, at least given what the platform and the policy proposals look like right now for Biden, juxtaposed to what Donald Trump and his team have done over the last 3 years.
Let me see what my oil looking like. Let me check my oil.
It would impact the equity markets.
All right, interesting stat there, Keith. I'm gonna circle my.
Like on this one, I got in at $20.
Keith Bliss, CEO of IQ
28, almost 29.
Thanks very much for having me.
Let me see what UCO look like.
From the Federal Reserve this week. Coming up next, we're going to speak with a former
I got in this one
Fed president about that and more.
21.
Right after this.
It's at 29. Let me check and see what goods look like. Hey, I told your dad to get in on this one right here. I told your dad to get in on this one right here Friday. Look, I'm going to show you. Let me zoom in a little closer. Hold on. I hate when it's short like this, man. Hold on. I'm trying to, let me zoom in on this thing, man. It's being dumb. Hold on. I don't know why it's being stupid. Okay, there we go. This I want to show you right here. I told your dad to get in on this one. I told him to when he had called me, right? I got in this one at 30 something bucks, right? I told your dad to get in on this one Friday. So it was about 40 bucks on Friday. It's $52 right now. No. It's $60 right now. Look. Oh man, your boy is y'all boys gotta start listening. Y'all boys be sleeping on the job, man. Hey, I'm about to call my dad and tell him to give me my cut, man. I told my daddy to get in on this one. I told your daddy to get in on this one. I was on the phone with your daddy. I said, look, I know you're trying to learn, but buy these two stocks right here. I think I gave him about 3 of them. I don't remember how much I gave him. But I do know this was one of them. And right now, your dad is rich if he did got it. I don't know if he got it. But it went up $15. $15 whole dollars. DALLAZ. Dollars. Oh, shoot.
Yeah, thanks a lot for having me on. I don't think that the Fed will be inclined to pull back at this stage. As you pointed out, certainly May, we've got a lot of welcome news. I think what was going on in labor markets. But with that said, the unemployment rate remains very high.
Yeah, because remember when I was on the phone with your daddy?
And as the Bureau of Labor
I was on the phone with your daddy, and it was about $42 or something like that.
Higher than that.
And now that junk at it was around this price right here, $42, anywhere between $42, $43, right? And now that junk is 61, 38.
And actually be thinking
I told him to get in.
if we move it in the summer, if we start
I don't know if he got in though. I think he might just be looking at it. Cause you know when people learn how to trade, they ain't want to put their money in it off the top because they're scared. I don't know if he did it or not.
Hey, Nariana,
But if he did,
on that point, you've written in the past.
Tell him to run me a check. I was just playing.
Maybe the Federal
I
Reserve
was
should take
playing.
interest rates negative, even deeply negative. You've pointed to the 10-year yield kind of pricing in expectations in the future.
Nah, see, people sleep on Gus,
90 basis points,
but I didn't sleep on Gus at all.
Feel like the Federal Reserve should
I didn't sleep on this thing at all. Like, look, let me show you
conversations
something,
that you've
bro.
heard publicly from current Fed officials.
I'm gonna pull
Do you
up
think that's even likely?
Well, I'll take the second question.
The 5-year chart, right?
First, I guess. Yeah, thanks a lot for the question, Brian. I think that right so far the Fed.
So as you can see,
one of the strongest messages
this
we've got.
Look. I'm just gonna go right here. Before it dropped, well, it did like a split. So it was around $80,000 before it dropped all the way down here. Of course, I loaded up on that, man. Cause look, that's nothing but room to go up. I bought, how many shares of these I bought? Let me see. I think I only got 10 shares though. But still, 10 shares. Just imagine when they come up and tap this line right here. That's $16,000. Times that by 10. You know what I'm saying? Not even that. Let me go down to this one right here. Times that by 10. Like, look. Y'all boys gotta stop playing with me getting these markets, man. Like,
very slow recovery.
that's why I don't work from 9 to 5 right here.
That doesn't prove to be the case.
I go to drill 1 week in a month,
I think given the Fed's
just so I can have my little insurance.
it is not inclined to be going negative.
Nariana, Brian Sazi here, and I applaud.
Let me check on my AAL one more time. 65%. Look, I'm 65% in profit. That's one. Look. 65, 37, 26. Come on, y'all gotta get with the program. Y'all gotta get with the program. Yeah.
More needs to be done here right now, and costs or adding to deficit is more of a issue to worry about at a later point in time.
Yes, I think that the message, the interventions, the policy changes that I suggested are ones I think you can get behind, whether or not you take a Keynesian or non-Keynesian view of the economy. Yes, they have some costs associated with them, but boy, we can. The U.S. government is in a very fortunate position, being able to borrow at very low interest rates. I think we continue to face. Despite we don't want to get ourselves.
That oil is one of the best. Like, the airlines was the best stock to get into.
Unemployment went down in May.
I don't know what's gonna happen at this moment, but it was the best stock to get into. And right behind airlines is gonna be cruises. So if you miss that boat on the airlines, you can hop in on the cruises.
The ball's really in Congress's court. The Fed, given that it
Cause see, this one has so much room to go up.
Well, they have limited room, but at the same time, they've only used up about half of the money that Congress appropriated to it through the CARES Act and that $450
so much room to go up.
I'm wondering, based on the design of the liquidity facilities that they've launched so far, things like the Main Street Lending Program, which are supposed to get off the ground.
These are all the key levels right here
future programs
with
that
this
maybe we
stock.
haven't heard of yet. What do you think the proper design should be? Are there certain tweaks that you would suggest, certain types of new liquidity facilities that you would like to see the Federal Reserve embark on?
Well, I think you're using the right word. The Fed is it should really be making sure we don't have liquidity shortages in the economy, and I think they've done a very good job on that front. As the chairman Jay Powell has emphasized, if you want transfers to be made in the economy, either to businesses or a household, that has to be Congress. The Fed's job is simply to make sure that lending rates are not too high because of liquidity problems in markets. And I think we saw big gaps open up in key markets, corporate bond markets, even in treasuries themselves in March. And I think the Fed has done a very good job at intervening to ameliorate that problem. Going forward, I really think you're going to have to see more. The ball, as I said, is in Congress's court.
All right, we're going to leave it there. Narayana Kocherlakota, former president of the Minneapolis Federal Reserve, also an economics professor at the University of Rochester. Thanks so much for being with us. Have a great week.
So buy some AL. I don't know about all that, bro.
Thank you.
Not right now. You know what I mean? Like if you miss it going up, then you kind of gotta wait to form another support.
Critical time. We'll be back right after.
I mean, unless you're okay with buying and holding for like a while, you know what I'm saying? Like it could still go up, but like, all right, let me show you how I do this. All right, I'm gonna break it down for you. Okay, let me show you. I'm gonna pull up the daily chart. All right, so I'm gonna look back on the left side. Okay, so this is coronavirus right here, right? So we're not gonna look. We're gonna look from this line to the left. Okay, so normally. Matter of fact, we're going to look from this line right here. This line right here that I'm on to the left. So what I do is the first thing I do is I like to mark areas where it struggles to pass, right? So as you can see, boom. That's my first mark because you notice that every time it gets here, it bounces up. Get here, bounce up. You see what I'm saying? It's not going to be perfect, right? And also, I'm going to do the top. Boom. So as you can see, it bounces between these two. So what you want to do is you want to buy here, sell here. Buy here, sell here constantly. And that's how you make your money. You don't want to buy in the middle because now you got room to go down and up. You don't want to get caught holding you don't want to get caught in that. You see what I'm saying? Like you want to pitch yourself. You want to limit your chances. You know how people always say the market's a gamble? Yeah, but you don't want to. You at least want to play smart. That's the best you can do, right? So that's why I would get in on right here because it can go nowhere but up. You see what I'm saying? Obviously, this is coronavirus. You know, everything failed here. You know what I mean? That's just common sense. You know. But outside of that, that's just how it goes. So like, look, if I scroll back to 2 years, boom. You see what I'm saying? Like it's still bouncing off the same line. Like sometimes support levels be resistance levels. Support is the bottom, like supporting the chair. Resistance is the top, the area where it struggles to pass. But sometimes it's just like I'm gonna pull back to 5 years, right? You know, even when you pull back, look, that same line I drew here bounces right here. You see what I'm saying? So that's what you want to do. You want to limit your chances. So that's why I'll pit some money here and take it up here. And you know how you always hear me, you ask me how much I pit, and I usually I'll pit like I'll buy a decent amount of shares here, and then if it does passes it, I'll buy a decent amount here. So for example, I'm gonna pull this down right here, right? So let's say I bought maybe 200 shares here, right? And it dropped below it because I'm expecting it to bounce up, but it didn't. Let's say it didn't. Boom, right? If I bought 200 shares here, I'll buy 400 shares here because when it comes up right here, this trade is in profit now. You get what I'm saying? And if it keeps coming back up, then obviously I'm good. You see what I'm saying? You can get out the trade whenever you feel like it at that point because of this bottom one. It usually doesn't pass 2 support levels. You know, obviously coronavirus is different, but normally it don't. I like to buy what they call support levels, you know, support and resistance trading. So what I was trying to explain to you is, let's see, if you go here, the only thing I can show you is this because that's the area that it struggles to pass. You know what I'm saying? And the area that it struggles to go up, I mean, you really don't have one right now because it just shot up out of nowhere. So either A, it has to come up. If it comes up here, yeah, you see what I'm saying? So like the only area I have for you for right now is this one at the bottom, which is probably not going to go back to because they're not closing the economy no more. This one, because this was a support level from the history, from the past. This one, because it struggled to pass this one before. But there's really nothing I can give you in this area right here, unless I make something up, which would be this, but that wouldn't too much be accurate.
operating a spa, a nail salon, a beauty salon is particularly
So you kind of gotta wait till it forms like another support level area that struggles to pass, because it did that out of nowhere. You know what I mean? So like getting in here was like, obviously perfect, but like you're never gonna know when this is gonna happen. You're not gonna know the breakout. What happens is you buy on support levels, right? So for example, as you can see, right here, right? This is when you see these gaps in the market, it's because it's the weekend. Sometimes over the weekend, the market goes up or down, or the market closes at 4, but you'll still see marks on the chart because people still giving money, obviously, right? So sometimes, even though let's say I have it set to get my money when it comes here, right? Actually, I had it set to get my money here initially. When I first bought this stock, I said I'm gonna take out right here and take profit. That's what I said. But what happened was, when the market opened the next day, it opened over my mark. Like it didn't open below my mark, it didn't went up. It opened over my mark and then shot up. So it didn't actually hit my mark, if that makes sense.
Have you had to raise any money?
We raised some money.
Like it didn't like shoot through my mark. It actually just started over my mark. That's why I didn't give you my money, and that's why I'm still in the trade on all of these actually.
Started to decline. We needed to help fund that, but I joined the company in February 19 for a turnaround, and like you said, we had, after an 18-month negative comp slide, we had 10 consecutive positive comp months. In 2020, we were well positioned for the turnaround, but then came.
I'm following. Yeah. So that's, I mean, everybody trades differently. I like to trade support resistance. That's just my style. It's just so easy to do. It's so easy to do, like all you gotta do is look at places that are struggling to pass, and then boom, that's it. And you can do it on any time frame. Like for example,
very interested in bringing this into their space, whether we leverage existing.
Rome the Don, what's up? So even when it hits our mark, you still profit. Yeah. So like I trade on a daily candle because my, I don't know, I'm all about having the higher the time frame, the stronger the trend, or the stronger the chances of you being right. So hold on, let me turn off the YouTube video 1 second so you guys can hear me better.
For the first trade to come, including Dunkin' Brands higher.
All right, so normally what I do is I like to mark the support resistance off usually higher time frames. And then when you zoom in, you can kind of still see it. You know what I mean? Because like this is 25 years right here. I mean, there ain't really nothing to see on this one. Hold on, let me see if I can pull it back to 20 years. Let's see what happens. And some of the stocks, you can't like I like to read from, another thing is I like to read from right to left, but some stocks haven't never been this low before, so you really don't got nothing to do but hope. You know what I mean? That's why I really couldn't give you a number to when to get in, because it never been this low before. So you know what I mean? So I have to wait until it actually passes a certain area, or it forms something that it didn't form before. You know what I mean? Let's see what this one right here look like. So let's see. See, this company started at least was on the New York Stock Exchange in 2013. So I can't look to the left and see a certain area, because this is the first time it's ever been this low. See that like right here, GE, right? That don't, it tapped this line, so I bought. I mean, what can go wrong? I'm gonna give you the same one I was Gush, right? Let me pull up Gush for you. The one I told you to get in Friday. What's up, Nico? Enob short. Let me look. Oh yeah, that's free money right there. Oh yeah. Nah. You good, bro? That's why you my boy. This man even told me good morning, boy. Go to the 2 minute. Let me see. My boy, I'm day trading. Yeah, I be on this. I swing. I do the swing. I'm cool with the swings, but I'm cool with the swing trading. But when I have all my money in the markets and I ain't really got that much left, then I do the day trading just so I can build my account back up. You know what I'm talking about? Like I'll do that from time to time. Nah, that's a good short right there. You can short that. I got in at 13. Ooh wee. So you eating, bro. You, you say you you saying it's at 9:30. Nah, that junk is tanking right now. I didn't miss my chance. Yeah, see, I'm all about that support level thing too, bro. Yo, let me show you this trade I got in right here, bro. Yeah, nah, let me show you which one I got in on this one. I got in on this right here, bro. Look how much I'm profit I'm in. 68%, bro. I was minding my business, playing Dota, just to see bread on the table, bro. I ain't even do nothing. I just woke up and see money. All right. Yo, let me finish talking to the chat real quick. All right, chat. So, what I was trying to explain to y'all earlier, I'm gonna pull back up this right here, right? Patterns for identification lines for confirmation. Yeah. Yeah. Hey, boy, Nico, man. Nico's the OG, y'all. He knows what he's talking about. Yo, he trades on the 2-minute chart. I mean, if you trade on a 2-minute chart, that means you know the market. Like that's your middle name. You know what I'm saying? I trade on the daily time frame because I ain't that good. I mean, I know it's the same concept, but I like the daily, man. You know, sometimes it's about being patient for me. I feel like if I trade on a 2-minute, I get too impatient. Yeah, that's good, bro. Like I can do that when I ain't got no much money and I need to build my account up because I ain't scared to really lose nothing. You know what I mean? Yeah, cause like if I trade on if I trade on that 2-minute, man, you know, like oh shoot. But being patient is key sometimes for real though, man. But yeah. So a lot of people been hating on Gush because it was a split or whatever. And then yeah, I'm gonna be full-time trader. Hey, pro trader full-time position gonna be dope. That's what I'm trying to do right now, man. So what do you gotta do to be considered a full-time trader? I mean, I do trade every day, but I don't day trade though. I do the little swing trades and call it even. But yeah, chat. So I've been looking at this one right here, and obviously, this one was a split, but it's still worth the buy, man. 42% gain. I think somebody just told me that. I think I seen that in your Discord. I think I might have said that. What's up, Matt? I seen that in your Discord. Yeah, but like this one right here, Gush. This one can do nothing but go up. I know it's a split and everything, but a lot of people still buying, and that means it's gonna go up. So I got in on this one at like 37 bucks, and it's already 62. You know what I'm saying? 62, and I ain't even did nothing but mind my own business. I'm getting paid to mind my own business, y'all. You have to be consistently profitable and look up some. Yeah. So look, let me show you. I got multiple. I got this, and I got my Robinhood account, right? So obviously on this account, this is how everything look right here. And then on my Robinhood, I'm in profit. Matter of fact, on Robinhood, I'm in profit on everything. And I have 1, 2, 3, 4, 5, 6, 7, 8, 9 stocks on there. UCO profit, USO profit, some medical stocks I'm in. Gush is on my Robinhood. Resi still there. Another company and Spirit. I'm seeing profits now. Yeah, pre-play. Yep, that's what I do. So what I normally do is because see, when I first started, I used to just click buy. You know what I mean? But now I don't even do that. You know? No. I use Robinhood because when I was trying to invest into certain stocks, it was blocked for some reason. So I didn't want to get, I think it was like oil when it had went to like 1 cent or something like that. You know, when oil had crashed, my bank wouldn't let me buy it for some reason. So that's why I got Robinhood so I can buy it. I didn't want to miss out on that. Yeah, but this is my main right here. But Robinhood's coming up because of the oil and all of that. But yeah, so what I normally do is I mark the charts too. You know what I mean? Support, resistance, trend lines. I do all of that too, and then I'll set buy limits. You know what I mean? And if they don't touch it, I don't get it. Yeah, if it gets real close to it, I still don't get it. If they don't touch it, that's just how it is. Like even though I be wanting to press that buy button, I wait for it to touch. Cause if I just press buy, then that means I'm impatient. A lot of new traders, a lot of new traders to take advantage of in these small caps. Xbar, let me see Xbar. Are you shorting it? Let me look. Oh yeah. I forgot to trade on the 2-minute chart. Hold on. I gotta remember that. You say you shorting it from 219? Oh no, you eating right now. Go ahead and buy me some pizza, man. No. He's shorting it. He trades on a 2-minute time frame though. Yo, Nico, yeah, he trades on a 2-minute. I don't do that 2-minute. I ain't that good. I mess around and lose all my money. I gotta move back in with my mama. Yeah, nah. Shit, if I buy in a 2-minute, what makes forex different from the stock market? All right, check this out, bro. Before I started trading, I was investing into stocks, but trading wise, I like stocks better than forex because I, any little thing can make the forex market move. From based off my experience now, but any little thing can make the forex market move, right? But for stocks, it's like the individual stock itself makes the stock move. I know that kind of sounds crazy, but like for example, the president can say something and it's going to cause forex to shake up. You know what I'm saying? That's why I really didn't like it that much. Versus stocks, the president can say something good or bad. You know what I mean? I don't want to say too much because I'm streaming, but it's not going to cause the market to shake up that bad like forex does. You know what I'm saying? Like for example, during coronavirus, Amazon, boom, still making a killing. You know what I'm saying? Stuff like that. You know, it'd be stuff like that. And then not only that, what kills me the most in forex is swap fees. So you can hold a position as long as you want. Like most of my trades I got in stocks, not most of them is dividends, right? They got dividends. So for example, I got some trades I'm probably losing right now, but I can care less about losing them because I'm getting dividends from them. So either A, I'm getting paid in dividends, or B, it's going to go up, or C, both of them, and the swap fees kill me the most, man. And when you look at stuff like market cap and the news and see what they're doing, you kind of, you know what I mean, it'll help you a lot with trading stock. Unlike forex, you kind of just gotta hope you do it right based off the lines you see, kind of thing. You know, it's just, I mean, that's just what I got out of it. And then swap fees and stuff like that. And then like when I'm trading stocks, I mean, I don't even set a stop loss when I trade stocks. But when I'm trading forex, you gotta have a stop loss, man. You know what I mean? You gotta have a stop loss. Ain't no ifs, ands, or buts, man. Cause like there's no coming back, man. Like with stocks, Google can come out with a Google car and you good, you back. You know what I'm saying? But forex is nothing. It's nothing to help you. It's just you just gotta know what's going on. You could be on the right side. Yeah, that's too much though. You know what I mean? But like, look, all I gotta do is be like Apple. Like when I got when before I was trading, like when I got into Apple, it was coming out with the new iPhone. So buy it, buy the stock. It's that simple. Like I don't like having to do too much thinking. You always gotta have a heart. Yeah, I do. If it's crashing, then I do put a stop on it. I do. I know what you're talking about. Like if it's crashing, then I put a stop on it. But if it's not crashing, it's not that much big of a deal like forex. Like I like some stocks I do. Like when the coronavirus first happened, some stocks were just tanking. But at the same time, you really don't. You can just hold it and it'll go up eventually. Yeah, I know what you mean. So that's why I buy on support levels too, though, because if it hit the second support level, they don't usually pass two set support levels, but if they do, then I might got to get up out of there. You know what I mean? But it all depends. It's not that. It's just not as bad as forex, in my opinion. Yeah, no, I don't do it like that. I usually do. I do support resistance, and then I do look at market cap too, and I just make sure everything's good. Yeah, that's what I do. That's exactly what I do in my trades. No, 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 no. You're right, bro. These people still trying to learn how to trade, man. People start trying to learn how to trade. But yeah, I look at trend lines and support resistance. That's me. He said Friday was a busy day for him. Hey, hey, you know what I mean? Like he would have been straight. If he got in, he would have been so happy. He probably would have flew me out to y'all just to tell me how happy he is, man. He would have been straight. My fingers hurt from typing. Let me check. Let me check on see what else going on. Gus is still climbing. Yo, when you it was just I was just telling you how it was $15. Now it's 17. Almost 18. Oh man. Like why go to college when all I can do is press buy and sell and still make money? Like college is a waste. I don't need to go to college. You said my mentor is up 78K this month. Damn, the month just started yesterday. This month or last month? Oh, because the month just started about 5 days ago. That's what I'm trying to do. So that's why. Okay, so I will tell you one thing: trading forex helped me a lot because in forex you got to be more careful. So what I did was, I was much more careful when I was trading forex. You know what I mean? And yeah, I was much more careful when I was trading forex. And I had to make sure I knew what I was doing. And I traded with a small account. Like right now, I use a small account because I know with a small account, I gotta be careful because I was more focused on winning the trades, not making $100,000. I mean, yes, I do want to make $100,000, but I gotta focus on winning before I focus on making $100,000. You know what I mean? But I'm sure you understand that. Yeah, see, day trading is scarier, man. Day trading is scarier for me. Yeah, but I just don't really like it, man. I just don't really like forex like that. Yeah, that's true. So it seems to me that around $18. Wait, $18 seemed to be a decent support level on the hourly chart. I hate the swap fees too, though, man. You know what I'm saying? Like the thing about stocks is I don't mind losing a couple dollars because I know it'll go up eventually, type of thing. Versus just forex, it does what it wants, you know. I mean, that's what I got out of it, you know. I mean, at least when I was doing it. $18.15 seems to be the support level for American Airlines, at least on a 60-minute chart. So I think it might stay around this area. Yep, I got it in the Carnival at $9. I sold at 16 because I didn't at that time I didn't know the market was gonna do this. You know what I'm talking about? Because before it would go up and then come back down, go up and come back down constantly, just like that. Nah, I've been in American Airlines a couple of times. I got in this one about two or three times, and I got in and it shot up. So I'm gonna see where it struggles to pass, and I'll probably sell it at that area. We'll see. I gotta see it where it closes at in the next couple of days. But I do know $18 seems to be the support level because it looks like every time it touches this, it bounces back up. $24.50 resistance. You talking about for AL? Let me check. Where you see that at? Why 24.50? I don't see. Is it? Are you talking about because of the way this candle closed? I mean, yeah, yeah. That's what I'm going for. I was actually going for that today. I want to see what's going to happen today. I was going to sell mines around that area too and wait for a pullback and get back in later. Oh yeah. I know what you mean. Nah, I don't get caught up in that. Like sometimes, like even if it's perfect here, well, buying I like the buying to be perfect, but the selling I'll take a zone. You know what I'm saying? You know what I mean? Like buying, I want to touch the line because I want that perfect entry. But when it comes down to selling, like if this was the highest part right here, I'll sell about right here. You know what I mean? Because sometimes you just don't know. Support resistance. Hurts. Oh man, I sold that joke, bro. Like I got in at $1, and I sold that joke at $1.10. That joke is moving right now. Short. It's too late, ain't it? I don't think this let you short. Hold on. I think I tried to short this one, but it was like I couldn't. Let me try. Nah, that seems to be a good area though. Yeah, you had a good spot. That is a good spot. I'm gonna keep my eye on this one. I'm gonna sell in a little bit. Damn, that joint's still running, boy. All right, let's see what these people talking about.
Right. No, there's no. We haven't announced timing, but we need a robot lawnmower. Everyone knows it's probably the most asked for next product. So worry not.
All right, let's leave it there. Colin Angle, co-founder and CEO of iRobot. Good luck on the lawnmower launch, and we'll talk to you soon.
Okay, thank you so much.
I appreciate it. All right, do stick around. Much more ahead on the first trade on the other side of the break.
Damn, yeah, that's which one? Ain't that? Thank you later. All right, bro. Just because you told me to. Let's see.
Welcome back to the first trade. Let's get right to Inez Ferre for a look at some stocks that are moving in the early going. Inez, cruise line stocks. They had a big Friday and they look hot right now.
Double-digit percentage gains for the cruise liners. Take a look at some of them. Norwegian Cruise, you can see up more than 10%. Carnival also higher this morning, up 11%. And over the last couple of weeks, you see that they've really rallied. This is their performance. Royal Caribbean also up today. So far, the no sail restriction for cruise liners is set to expire on July 24th. Also taking a look at American Airlines. That stock is up more than 6%. American giving out details for its severance packages for high-level employees who volunteer to take a buyout. The company has said it plans to reduce the headcount after September 30th, and it was looking for volunteers to come forward. We're starting to get some details of those severance packages. Severance package for some employees will include 9 months of pay and a little more than 2 years of health care. But the airline stocks also on Friday were rallying today as well, up more than 8% for United, Delta, up more than 5%. And I also want to mention Mesa Air Group because this regional carrier says that the block hours flown in May were down 68.6% from a year ago because of reduced flights due to COVID-19. But take a look, the stock today is up. So over the last few weeks, these travel stocks have really been rallying, gaining back some of their previous losses. Brian?
All right. Thanks, Inez. The markets continue to be hot as New York City finally enters into phase one of reopening, but the nation's social conscience continues to weigh on investors' minds. Joining us to digest some of this is Katie Koch, co-head of fundamental equity at Goldman Sachs. Katie, good to see you again here. In your view, someone who looks at the fundamentals of companies, the stock market is melting up right now. What is the market saying about the future direction of fundamentals for companies?
Yeah, so it's very interesting how resilient markets, in fact, have been. They were up another 5% last week on the back of that social unrest and some other challenging data points from parts of the economy. And in fact, actually, we capped off the best 50-day rally we've ever had in the history of U.S. equity markets. So I do want to touch on the social unrest really quickly for a second, because I think in the near term, markets have been able to look through that. But in the long term, as a business community and as a nation, if we don't do something to address the cumulative
You in an hourly chart, or I know you trade on the 2-minute chart, right?
Racism in this country, we are going to be facing some pretty significant challenges to the economy and to the markets. And just briefly on that, I think rightfully leaders are being asked what they're doing specifically to address that. And I just want to say quickly, I co-head, as you know, our fundamental equities business at GSAM. And as part of that, I oversee our stewardship and engagement effort for $300 billion of direct equity. So
Yeah, I don't usually short. I don't usually short.
To racial equity is actually pushing for better.
I don't usually short unless I'm getting in and getting out right then and there.
Diversification stats. And I'll just end by saying that, we are very big believers that diverse teams perform better. Half of our assets are run by women. We need to make more.
You say you got your stop loss at where? $12.
Actually, are one of the first major asset managers to vote against the nominating committees of any public company without a woman on the board. And we would like to do the same thing for racial diversity, but we lack the data. And as any good investor or management team knows, if you can't measure it, you can't push for the improvement that you want to see. And so what we're really committed to doing through over the next several years is pushing for companies to report more broadly on workplace demographics, so we can align our engagement and proxy policies to push for better racial equity. And this obviously isn't the panacea answer to the situation that we're facing, but we think it's quite foundational in terms of what for gender equity to do to push for greater racial equity.
Katie, clearly more work needs to be done in that area, but there has been some progress made. In
I mean, I still know how to
intraday
trade though. I still do that because remember I trade forex, and that's what I would do with that.
Sectors that are better at diversifying company boards, diversifying in-house than others?
Actually, where you see better is across cap. So larger cap companies are better on some of these gender issues than smaller cap. And again, it really comes back to this issue of disclosure. We need people to put the data out there to hold them accountable for improvement. And I am happy to go back and pivot and talk more about the near-term dynamics and whether this market rally is sustainable. But I wanted to make sure we did.
You say you gonna take this all the way down to where? $5?
Greater economic inclusion and
the next support level is $5.
Long-term stability.
No, absolutely. And I'm glad that you did. And when you're saying that the larger cap companies, perhaps because they have more resources, are more transparent, perhaps, but I'd love to talk about their performance in the stock market recently because, typically those smaller cap stocks are, I guess, more sensitive to economic shifts than the larger ones. How have small caps been faring versus the large caps? And what's your position there?
Sure, absolutely. So small caps are the ultimate recovery story. And actually, when I had the privilege of being on your program about a month ago, we did encourage investors to commit capital to the small cap markets. And they are up 15% really over the last month, outperforming large caps by 5%.
Let's see.
So we have started to see that recovery out. I would say we still think that small cap companies are a very worthy place for clients to commit capital. While they have started to recover, I would remind investors that actually when you look at their total recovery off of bear market bottoms, particularly in the growth part of the small cap market, it's a 60% return.
1 second. We're back. Make a sandwich real quick.
And they outperform large caps over that bottom of bear markets about 20% a year forward. So there's still a lot of room for small caps to go. And while they have started to recover as we anticipated, we think that it's reasonable for clients to commit capital there.
Katie, getting on the diversity front, getting back that, the ultimate sign of holding management teams accountable, I would imagine, is selling their stock. So if these companies don't put forward plans that you find acceptable, are you willing to say, you know what, we're not going to give you any more time. We're just going to go out there and sell your stock?
Yeah, so that's one of the reasons that active management is so important because unlike passive indexes, if people are not adhering to best-in-class policies across diversity, but also a variety of issues, we have and we would divest from their shares. And obviously, we need our peers to join us in pushing for better disclosure, which is something that we're really hopeful for.
What about in terms of dividends and buying back stock? I mean, are those things that you would be looking at as well? If a company sort of wasn't transparent in the way that you'd like to see, the diversity wasn't sort of ticking up and happening at that company, are there ways to sort of, in essence, keep them in line by putting some limits on things like buying back shares or dividend payments?
I think the best way to hold people accountable is to engage, for them to have more transparency and more disclosure, and then to align the proxy voting process to push for those things. And also, again, to get our peers involved too, because we need the whole industry to move in that direction. And I actually think it's that really the answer isn't so much in restricting the capital structure, but is in pushing for the transparency and the reporting that we can hold them accountable for. And just going back to gender for a second, where we've had more progress, we voted against 200 companies in the U.S. last year for not having a woman on the board, and about half of them have actually added a woman on the board since then. So we know that when people disclose data and you align your engagement and proxy policies for it, you can push for change. So I don't mean to sound like a broken record on it, but we need the data. And as any good management team knows, if you can't measure it, you can't push for the progress that you want to see.
Katie, the Goldman team.
What's up, man? Nah, I'm not in on the
Hurts.
Hertz. I'm not in on the Hertz. I'm just
starting to seep into the market. Are you
looking at it. It's coming down
in the market when they say when they get more worried about the election?
Let me check this one right here.
What action should investors take?
Yeah, so because I think as an investor, one of the most important.
At first I was just eyeballing this right here. I'm trying to mark it up so I can know when to get out. So I'm seeing the support level being right here at 18, which is good. I just need to find I need to find me a good resistance level, man, so I can get out and get back in. Because if I find that, then I mean I can sell. Let's say this is the resistance level. I can sell that 21. Hop back in at 18. Take that baby to 21 until they figure out what they want to do. Until they figure out what they want to do. Sometimes you gotta do that. Posted before and mid trade updates in your Discord. Enob. Let me check out my Discord real quick.
The tech big platforms in particular are up 18%, but the median company in the U.S. market is
Enob short. Let's see.
below its high. So
yeah, short, right? So you
in this market accounting for
shoot, my man over here. Hey, do it through Trading View so we can see where you got in at, which candle, all that other good stuff. You know what I'm talking about?
And we talked about small cap.
Trading View just makes it look a little bit neater. I mean, in my opinion, though. But I'm sure everybody else understands that too.
Where we think that there's secular growth.
Size management. Oh, you just be
priced in, which is a change in supply chain dynamics as we localize supply chains. It is the rise in millennial consumption behavior across.
I just love waking up seeing green, man. Like
the amount of online
check this 8 out one real quick.
Penetration. We went into this crisis at 16%. We think that may now be as high as 27%. So we've effectively seen 8 years of penetration come in 8 weeks, and we think that we're invested in the companies supporting the infrastructure of that. And then finally, future of healthcare. We talked about genomics last time, but medical devices, that's a great example of healthcare's recovered for the year. Medical devices, things like robotic surgery, which we're extremely optimistic about, still down 10% on the year. And so while we're not excited about overall market levels and valuations are stretched, my point to you is that if you look below that, this is actually one of the best opportunities that we've ever seen for active management. And we can identify a lot of opportunities at the individual company level.
All right, we'll leave it there. Katie Koch, co-head of Fundamental Equity at Goldman Sachs, always bringing us some really, really good insights. We'll talk to you soon.
Thank you so much.
All right, stay tuned. Much more ahead on the markets on The First Trade. Welcome back to the first trade. Let's take a look at another company we have our eye on this morning. Rumors are continuing to float around there on Wall Street about a potential merger between Gilead and AstraZeneca. The companies will face political and strategic hurdles in making this deal potentially come to life. Yahoo Finance's Inez Frey is back with us. Inez?
That's right, Brian. And according to Bloomberg, AstraZeneca had approached Gilead about a potential merger last month. And you can see that Gilead shares are up 0.7% this morning, and AstraZeneca's down about 2%. Now, no information on the terms of a potential deal. The two companies have a combined value of $140 billion. AstraZeneca is working on producing a COVID-19 vaccine. Gilead had remdesivir that was approved for treating patients with COVID-19. The London Times is now reporting that AstraZeneca may now be dropping interest in Gilead, with sources talking down the interest of a possible tie-up, basically saying that logistically merging would be difficult.
Hertz is dropping still?
Trading
Trading the best job on earth. Yeah, I love it too,
We're
man.
looking at these two stocks
I love
moving
it
a little bit
too.
in opposite directions on
You know what I
the
mean? Like one thing,
Brian.
see, as time go on, man, you got to stop being scared of the charts, man. Because sometimes it'll go one way, you get scared, we want to take your money out.
The spread of
You know what I
COVID-19
mean?
and job
That's why you got to
loss.
mark lines and
Also
just say,
mentions
well, if
that
they hit it, they hit it.
consumers think the economy
That's
will
what I
improve
learned to
over the
do.
next 6
Ooh,
months
Carnival,
as compared to just 2
$23.
weeks ago. Domo Chief Strategy Officer John Miller joining us now for more. John, as employees in more and more cities start to head back to work, New York City among them today,
Come on, just
Domo
get up
has
there and
a
give me my
COVID-19
money.
tracker. Explain to us what that is.
I ain't gonna
What are you
complain
tracking?
though. That American Airlines know what they're doing.
Yes, so Domo is a company that helps other businesses modernize how their businesses
Look at this
run
right here,
by helping them
GE,
leverage
looking
their
good.
data
I ain't even
at
bought that
massive
many of these
scale
though,
and in
so
record
I don't even
time.
care.
And what we've done with this coronavirus tracker, which you can find at domo.com/coronavirus, it's free. It's everybody can go and see these trends. But we've
Y'all chat,
aggregated
I need y'all to
a
pray for
massive
me,
number
y'all.
of data sources so
Somebody
that
just
we
told me
can
I look like a
see the
popular
broader
green alien.
mosaic of what the data is painting
Like,
around
it was
people.
fine if she
So
just
we can
said
see things
green
like
alien, but
where
she told me a
are tests
popular.
happening, where are infection rates happening,
I've
where
seen
deaths
that.
happening. But we've
Yeah.
also been able to layer on interesting data that sort of gives the broader context. Things like
A
what types of
popular,
stores are seeing bigger foot
a
traffic, what types of
popular
brands are bringing
green
foot
alien, y'all.
traffic. So lots of data that comes together in a single mosaic because it's really about the context, and it's different for each business and each region.
John, given how important some of your technology is, and data is just the lifeblood of companies right now, what does your government pipeline, contract pipeline look like?
Yeah, so we've seen, a lot of times in this early crisis, what we saw was the governments were really trying to respond, to understand how do they best protect their citizens and manage the environment for those citizens in the state.
I'm gonna keep my eye on this
We started
one.
working with the state of Utah and worked with them very closely to just bring together the data. Again, it's about the mosaic, the different types of data, and a lot of the systems in these states, they just weren't built to talk to each other. And what Domo does is it brings our platform into these situations where now you can pull data together from the epidemiology data, the hospital data, the testing data, and you start to see where are the hot spots and where are things improving, where are things getting worse. So we worked with the state of Utah, and within 72 hours, we were able to build a command center that they are now using to manage the decisions across the state. We've since done the same thing with Nebraska and with Iowa. So we're helping these states manage the situation, which is incredibly dynamic. I mean, data that used to be acceptable to get maybe once a month or once a week, now we really need hourly.
So what are the trends you are seeing in states where they're starting to now see an uptick again? There were reports this morning that as more states reopen, they're seeing a bit of a resurgence in those COVID-19 numbers, something that the epidemiologist told us might happen. How is your data helping those different cities with sort of this second wave?
Sure. So we believe so much of this just needs to be data driven. We need to be very objective about these conversations and how we're making decisions. So if you go to domo.com/coronavirus, again, you'll see this data. And we just introduced a data explorer feature. So you can go there and see which states are trending. Where are some of the hot spots? We're seeing Arizona, we're seeing Florida, we're seeing Tennessee that are ticking up. You can also look at it at a global level. You can see some of the hot spots: Pakistan, Brazil, India, and you can drill down at the county level. So wherever you are personally, or wherever you're trying to run a business, because this is really quickly getting to an onus on the employers to understand the environment where their employees are going to need to go back to work should they choose. And so how do we shift from, we've done a lot of work with governments to help the citizenry get comfortable and then open up the economics. But now it's moving to the companies, the enterprises themselves, to help create an environment where employees feel safe and understanding what are the best places to open up or offer opening up more quickly. And that's where we're shifting to this Get Back to Work initiative. We think that is just really critical.
John, you mentioned a couple of times that accessing this information is free. That's something we can all do online. How does Domo make its money? And are these states that you're working with, I would imagine they're paying you?
Yes, they are. So the data that we're doing for the coronavirus tracker is free. We feel like that is a service that we need to offer to the country and to the world to help bring this data into the context and make it available for them. In fact, we've had hundreds, I think 700 of our own customers have taken this data and embedded it into their platform. But how Domo makes money is our platform, which again helps companies modernize how they do business by leveraging all of this data and doing it at massive scale in record time, helps them put the data of their entire organization in context. So now if you get down to the organizational level, to the company level, you have roles within the company that have completely needed to retool or modernize how they think about their business. Think of the role of the CFO. For example, they may have been okay getting data on a quarterly basis or a monthly basis. But now CFOs are looking at things like cash collections. What's my cash position? What are my daily sales outstanding? And they're looking at this in real time. I want to know hourly as things change. So the Domo platform brings this data together in real time and helps make these decisions for CFOs, for marketers, for chief revenue officers, all run their business in a much more real-time fashion. And in a way, Domo is just built for this environment.
All right, let's leave it there. John Malor, Domo Chief Strategy Officer. Good to speak with you this morning.
Thank you.
All right, do stick around. Much more on the markets, stocks, and the latest on how social media companies are playing in the social unrest we're seeing sweeping across the United States. Stay tuned. All right, welcome back to the first trade on this Monday morning. Over the weekend, hundreds of thousands of people across the globe gathered to protest the killing of George Floyd 1 week after his killing. And while Americans have been protesting racial injustices for decades, these protests look a lot different in part because they're fueled by the power of social media. Instagram, Facebook, and Twitter are all playing a critical role this time around in spreading awareness and important information about the Black Lives Matter movement. The Social Chain founder and CEO Steve Bartlett joins us now to discuss. Steve, there's good to see you this morning. There is a debate going on out there on what should you post right now, and what shouldn't you post on Twitter, Facebook, and Instagram.
You know, I probably have somewhat of an unpopular opinion as it relates to this question, because I think that everybody processes such a deeply emotional, deeply personal incident like this in their own way. And I think this isn't a moment to care too much about correctness. I think this is a moment to care more about change. And what I want to see from brands as a Black man is the acknowledgement that once this stops trending on social media, I'm still going to be Black. You know, my kids are still going to be Black. And this isn't about being correct today. It's about how do we bring about systemic change that will last a little bit longer than a trending topic.
What do you find is the most powerful, if we can use that word, social media tool during this time? Is it Facebook, Instagram, Twitter? Where are people gravitating, and where does it seem to be taking hold? And maybe, you know, having this grassroots effort of change. Where are you seeing that amongst the social media platforms?
You know, it's spread across all of the social media platforms, but they're all serving completely different roles. Twitter is a platform that is built for discussion, especially real-time information sharing. So we're seeing news break first on Twitter. We're seeing incidents from the protests. We're seeing defacing of statues. We're seeing the looters. This is all playing out on Twitter. Some of this makes its way to Instagram, but Instagram is really about the consumer and their own platform giving you their own views, as opposed to really generating and fueling and building upon discussions. I'd say the two key platforms we're seeing at the moment are Twitter is really where opinion is developing, and then over on Instagram, people are expressing themselves. Facebook, I have to say, has been a little bit, full of a bit of misinformation still, and that's a bit of a problem. And then LinkedIn, we're seeing a little bit of a personal opinion emerging as well. But I'd really say Twitter, and full disclosure, I am very bullish on Twitter, because in these moments, it's got a remarkable capability of making the world incredibly small.
Steve, how should a big brand post something on one of these platforms? What should the messages be? Because I feel as though even during the coronavirus pandemic, you're seeing a lot of brands go out there and post on social media and also on TV. They're trying to sound sympathetic, but they're coming off kind of fake.
So there's a couple of things that are super important here. I'm gonna really focus on one, right? Which is, I'm gonna focus on two. The first one is I'm gonna focus on contradiction, right? We live in a glass box world now where all of your employees have Instagram and Snapchat and LinkedIn, Glassdoor. They can all speak to the world about the true nature of what's going on in your business. So if you say one thing on social media, it's literally the worst thing to then be internally contradicting yourself. If you have an all-white board in your company and you're telling the world that you are X, Y, and Z, this will be pointed out in a matter of seconds. And we've seen this weekend, actually, in one of the major newspapers in Europe, the Nike board has been revealed as being pretty much all white. They showed all of their faces in the newspaper. And this posed as a bit of a contradiction to the messaging that we've been seeing from Nike, which has been pretty amazing. I'd say the next thing is, it's easy not to screw up if you mean it, right? And so don't view this as a moment, a PR opportunity. View it as a moment for real change. And when you do that, as our company have done, we're listed up, we're a public company, Social Chain, we're listed, we've got 700 members of our team. I told my team that I'm not trying to be correct. I'm not trying to produce the perfect PR statement. We're going to start internally. We're going to start with real change internally, long-term goals. We're not going to put out a press release telling the world how great we are or virtue signaling. We'll tell the world when we've done some of these things. And I think that all comes from, again, that realization that this isn't just a week for me. This isn't 2 weeks. This is my life. And I'm going to be Black for my entire life. So I care about real meaningful change first and foremost.
Steve, you mentioned misinformation on the Facebook platform. We know there was a virtual walkout of Facebook employees. Mark Zuckerberg, CEO there, coming under a lot of fire for the way they're handling or not handling, however you fall on this topic, the President Trump's posts. Is this going to be something that Zuckerberg's going to be able to bounce back from, do you think?
Do you know what? I have to be sympathetic towards Mark Zuckerberg, something that people aren't often, because he has quite an impossible task. Donald Trump puts up a post that says when the looting starts, the shooting starts, which is to some has racial connotations and a racial history, but also is seen as to some as inciting violence. And Mark Zuckerberg has a choice there. He can either take down a president's post, which again might be seen as a violation of free speech to some of his employees, which might cause a walkout amongst some of his employees, or he can leave it up in the interest of public, in public interest, as he said in his letter this week. His choice was to leave it up. It's a situation where you just can't win.
Hello, everybody. I'm back. Any new things you guys see? You guys want to tell me about?
Argument. Do I think he'll come back from it? I think that, I've seen this huge anti-Facebook narrative for a very long time, so I don't think Facebook can really do much right anyway. But yeah, I think people will move on to the next thing pretty quickly.
All right, I'll leave it there. The Social Chain founder and CEO, Steve Barlett, always good to see you. I appreciate the insights, and we'll talk to you soon.
Thank you.
All right, let's get back to Inez Ferre for another closer look at the markets. Inez?
And Brian, the Dow up 0.9%. Energy and industrials outperforming today. Technology and communication services are lagging. And let me show you Boeing up more than 11% right now. Boeing over the last couple of weeks, really over the last 3 weeks, up 88%. And then just taking a look at Apple. Apple this morning down 0.5%, 0.5%. Apple on Friday hit a record high this morning, slightly under pressure as technology and communication services lag. Brian?
All right. Thanks so much, Inez. Do stick around. Much more ahead in the markets. Straight ahead.
Welcome to Yahoo Finance on the Move. I'm Adam Shapiro along with Julie Hyman. It is Monday, June 8th, and we are watching the rally continue on Wall Street. NASDAQ is up over 15 points. Dow is up more than 250 points. The S&P 500 has been up more than 13 points today. We're also watching crude oil pulling back a bit. It is down WTI about 3.75%. Some of the headlines which are driving markets today: oil giant BP plans to cut 10,000 jobs. That's roughly 15% of its workforce, and they intend to do this by year's end to deal with the new energy market realities, as well as a shift toward renewable energy. Now, this follows OPEC's announcement over the weekend that OPEC allies agreed to extend the cartel's production cuts for another month. They're going to review those cuts next week to see who among their membership may be cheating. New York City entered phase one of its reopening this morning. That includes curbside pickup at retail outlets and a return to work for construction, manufacturing, and wholesale supply chain workers. The MTA, by the way, that's the subway system. It's going to run at 95% of its usual service. And a new report says New Zealand has eradicated the coronavirus. Our Angelique Hamlani will join us to discuss what this means and lessons for countries worldwide. The number of cases worldwide, 7 million testing positive. The number of dead in excess of 400,000. In the USA, 1.9 million have tested positive, with the number of dead exceeding 110,000. We have breaking news from the World Bank, and Brian Chung has that for us.
Well, Adam, the World Bank just releasing its update on the global economic forecast and its global economic prospects report, which it just dropped a minute ago. It said that global GDP will shrink by 5.2% in 2020. That is the worst since World War II and 3 times as steep, for comparison, to the 2009 global recession. Now, they do expect a rebound in 2021. They said that global GDP could come back by 4.2%, but said an even worse scenario is possible if the world cannot get together and contain the virus, meaning no second spread in certain corners of the world. Now, this is a gloomier forecast at negative 5.2% than the projections that were offered by its sister organization, that's the International Monetary Fund. Keep in mind that back in April, the IMF projected that the global GDP would contract by only 3%. Again, this much worse at 5.2%. Specifically, the World Bank is flagging Latin America, Europe, and Central Asia. Keep in mind that there are cases increasing in Brazil, for example. So even though in areas like China and in the United States where things are reopening, there are new pockets of the world where the COVID-19 crisis could get even worse from here. For the U.S. specifically, the World Bank says that it expects a negative GDP of a negative 6.1% growth here in the United States for 2020, but does expect a 4% rebound in 2021. Keep in mind, the World Bank does say for right now, it says governments should be aware of providing even more fiscal policy support to make sure they can stop the bleeding. Adam, Julie?
So let's try and understand what all of this means. And to help us do that is Diane Swank. She is Grant Thornton Chief Economist, joining us now from Chicago. Thank you for being here, Diane.
Good to be here.
So I don't know if you've had a chance to look at what the World Bank is saying, but I don't think it comes as a surprise to a lot of people. But when you take into consideration what happened with the jobs report on Friday, job gains are welcome, as you point out, and may suggest the economy hit a bottom in the United States in May. Is it too soon, given everything we're digesting, to make that kind of prediction?
It is, because we do know that the PPP, the Payroll Protection Plan, actually did help in boosting those job gains. We've seen changes to the plan since then that will stretch out the job gains more over the second half of the year, less concentrated, so that we'll actually hopefully save more small businesses out there. I think the other important issue is that there's a lot of headwinds that persist, and you're going to see that echoed in Jay Powell's comments when he talks about, after the Fed gets done, that the government is not done doing what it needs to do. The Federal Reserve can lend, but it cannot spend. And Jay Powell has been very consistent on his pleas of Congress, particularly for state and local transfers for state and local governments. We have a headwind of June 1st, where not only do we have many things of the support that we provided, excuse me, in the United States playing out, but also June 1st is when many fiscal years start for state and local government budgets. And we've already seen the cuts continue at the state and local level, and that could be a major headwind to the economy gaining momentum in the second half of the year if we don't see transfers to state and local governments. And this is every state is affected. California is, of course, was the largest state to go in at the beginning of the shutdowns, but we've got places like Florida, Nevada, Texas, all being affected by these closures because of the loss in revenues that they suffered for nearly 2 months' time and the cost of fighting COVID itself. So there is no state that goes untouched, and we really need to continue to see fiscal stimulus out there. Much of what the U.S. had, there was a lot of it. Not all of it is targeted as we'd like. And now we really need some more targeted stimulus or relief, as I'll put it, to get through the summer and make sure that this recovery really takes hold and doesn't dip into a double dip in the fourth quarter when we might see a second wave of the infection.
Diane, it's Julie here. Do you think the danger is, though, that with the jobs numbers on Friday, that takes some of the wind out of the sails, that Congress will not be as motivated to make the moves that you're talking about?
Well, we certainly saw some of that initial reaction from the White House that they were less motivated to, some of the speakers from the White House saying they're less motivated to put up fiscal stimulus. It is an election year, and that probably goes to the favor of needing more fiscal aid at this stage of the game. And, we're really not going to see the economy, to declare victory too soon is really a dangerous thing to do. And I think it's really important to understand where our cliffs are. We know as of July 31st that the extended and expanded benefits for people will end in terms of unemployment benefits, yet a lot of people will still be unemployed. And that could really set you up for a cliff over the summer. So yes, there is some, risk that the good numbers we saw take some of the wind out of additional fiscal relief. That said, I think the case is still very strong. And I think you're going to see Washington have to step up to the plate. Do they step up to the plate as much as I'd like them to? No, I don't think they will step up to the plate as much as I'd like. I think that there still is sort of a lack of recognition of how damaging COVID-19 has been and how damaging the behavioral effects are as we continue to deal with, sort of recurring outbreaks across the country.
Diane, it's Julia LaRoche. And to that point, you wrote this in your note, and I thought this was really interesting, so I'll read it for our viewers. You said, quote, "We really need a new way to talk about recessions and recoveries in a post-COVID world." I was hoping to expand a bit more on that idea.
Yeah, one of the things that's really going on out there, and a lot of economists were sitting together talking about this, and the idea of an expansion and a recovery is, there's the part where you sort of contract for a while, and then you get to regaining ground lost, and that's how you typically think of recessions and recoveries, where we're going to be in the hole for a long time. We're only operating at a small percentage of the economy's capacity for a while until we get to a vaccine with COVID. We hope that long time won't take as long to recover as we saw from the Great Recession, but the pain is still there and it's so large up front. And so to put it in this sort of traditional framework that we talk about recession recovery, it really does an injustice to the ongoing and sustained pain of lots of unemployed people, a very high unemployment rate for a very long period of time that I think you're really not getting the grasp of when you talk about it in those terms. And so we almost need a new dictionary, a new verbiage to be able to talk about a COVID-related recession, which is a service sector recession. I mean, how long will it take until we see flights restored to the levels we saw prior to the crisis globally? A very long time. When is the next time cruises are going to be as full as they were prior to the COVID crisis? A very long time. We're talking about an 80-year trend in the service sector that we're derailing temporarily, but that temporarily is going to mean a lot of displacement and industries, an economy that looks very different than what it did pre-COVID for a while.
Diane, it's Brian Chung. It's great to talk to you again. And it sounds like, based on what you were just saying, that we should be buckling in for what could be a long recovery. Now, when you look at what the Federal Reserve is going to be doing with their FOMC announcement here on Wednesday, what are you going to be dialed into when it comes to Jay Powell's testimony? We know that the Fed has already done a bunch of stuff with regards to taking rates to near zero, quantitative easing, its 9 liquidity facilities. If it is going to be a long recession and we should expect the labor market to be in a slump for quite a while, how can you expect to see maybe the Federal Reserve prop that up when the recovery does eventually come?
Well, they clearly are, they continue to surprise us in their ability to sort of print yet another arsenal of tools to fight and combat the weakness in the economy. And I don't think that they're done doing that. We are going to see down the road, I don't think at this meeting we'll see down the road some more specific forward guidance. They are going to release their forecasts again, which we haven't seen in quite a while, those infamous dot plots. And I think in that you'll see some very, low rates for an extended period of time and also a lower neutral rate. Also, I think you'll see that the Fed is sort of worried about potential growth being much weaker than it once was in their forecast as they line up their forecast for this year. But as we get in later into the year, and if the economy really does struggle, as I fear it will, to continue to reopen and not reopen as smoothly as many would like, the Fed's going to have to be tying in their forward guidance on interest rates much more closely to what the unemployment rate is, what inflation is. They're going to have some actual targets tied to how long they're willing to keep rates down. I do also think we likely will see some yield curve control because I think we're going to see a deflationary shock from this. The Fed is going to want to go ahead and intervene and deal particularly with some speculation that we've seen in the 10-year market on the 10-year Treasury, but we could see some yield curve control where they keep those rates unusually low. And what they're really saying is what the market is already saying. The market is begging for fiscal policymakers, for Congress to spend more with negative yields after adjusting for inflation. They're saying, please invest in the future of the economy rather than worry about deficits and reducing those deficits at this stage of the game.
Diane, given what you just said about the need for Congress to get involved, what happens if they don't allocate money to the municipalities and the states? We know there will be layoffs, but as investors, where would we start to see that impact? Would it be in the muni bond market? Would it be elsewhere?
It's going to be really across the board because we've not only got the muni bond market very stressed as a result of this, and the Fed is willing to buy, but then, of course, you have much more precarious muni bonds and muni bond ratings. I think what you've also got is the issue of who gets hit. You're going to really hit higher education very hard along with education. So you're talking about 1 in 8 workers are employed by state and local governments now, and we've already seen a major hit to education. This also exacerbates the inequalities that we're seeing out there, and it makes it really is something that kind of undermines the entire infrastructure of the U.S. economy, and it's something that we've neglected for so long to do it. You sort of get to the point of having, a straw breaking the camel's back in terms of how much we're compromising state and local governments. And again, also the social unrest that we're seeing out there, this ups the ante on that as well, because you're taking away much needed services from localities that are the least served as it is. And so you're going to be pulling those forward as well, those kind of cuts. That's just not a place we want to go right now.
Grant Thornton, Chief Economist, Diane Swak, thank you very much for joining us. Let's hope members of Congress are listening to what you have to say. 1 in 8, that's a really remarkable statistic. We're going to move our attention right now to the coronavirus and news out of New Zealand, which may offer lessons for all of us. Also here in New York City, we started to reopen. Angelique Hamlani has more for all of us on that.
Thank you, Adam. Yeah, definitely some exciting news out of New York City, looking at all the different areas, as you mentioned previously, that are going to be part of that phase 1 reopening. It's been 98 long days for the entire city, and definitely seeing some excitement over that. What that means, and as well for public transport, still remains somewhat of a question. They have said that they're serving, essential employees, and whether or not that will start to include everyone else returning to work and reopening their businesses is still a question. We're also looking at New Zealand, as you mentioned, 0 active cases. We have seen reports about their very, strong push to close down the country and activity within there in order to reach this point. And so the celebration, of course, indicating that it is possible. One of the few countries to fully reopen after, seeing some cases. They hit, I think, about 1,500 total cases. But what's interesting about that, and there have been some articles about this, is that it's a relatively isolated area, smaller population, wealthy nation, and so it's able to do this, use this strategy so successfully, which is not something we might be able to import here in the U.S., unfortunately, because we do have such a widespread population, and as we're already seeing how that affects different parts of the country differently in terms of different states seeing waves at different times. So definitely some good news out of there, though, and what that means for travel as well. We know that the Prime Minister has, floated the idea of 4-day work weeks and how that could affect employees. So something that would be interesting to see how that supports domestic travel and tourism again. Another thing that we should be looking out for. Thank you, Adam.
I think a lot of people, when they hear 4-day work week, if that were ever to happen here, they would not be mad at that. Anjali Kamlani, good to see you. Let's talk about the stocks people are buying, because right now we are enjoying a continuation of Friday's rally on Wall Street. To help us understand where all of this is headed, Sean Cruz, TD Ameritrade Trader Strategy Manager, is joining us from Chicago. Thank you for being here. And of course, your investor movement index increased to 4.35 in May. That was up 11.5%. Help us understand what that means, and then we're probably going to ask you, what are people buying?
Yeah, so what we do when we look at that index is we don't just look if they're net buying or selling, but we sort of look at if they're taking on risks. So we could have months where they are buying, but maybe they're buying some of the safer, less volatile, lower beta stocks. That won't move the index as higher as if they are buying maybe some of those more higher beta stocks and just generally taking on more risk. And this month or May was actually the first month out of the past 4 months where we did see clients going out there and actually taking on more risk, being a little bit more aggressive in purchasing equities.
And it looks, hey, Sean, it's Julie. It looks like they were purchasing equities that were in areas that have been pretty beaten down. Leisure, airlines, Southwest, Walt Disney's on your list, Norwegian Cruise Line. So not just taking risk in terms of just buying equities generally, but buying some of the stuff that we don't really know what's going to happen with those particular companies.
They did, and it really continued actually what we saw them doing in April as well. And they started accumulating some of these names in April. And I think the April was really just buying the dip. Some of these companies were priced essentially where there was a legitimate risk of them defaulting on some of their bond payments. And I think that was something that was very worrisome for equity investors. So they bought it, started in April on those just extreme lows. And then I think in May, as we started to get some reopenings going on, they started allocating a little bit more in there as they were sort of getting this back to work. I view it as we're moving from the stay-at-home trade to the economy reopening trade. And so that's why you're seeing them go out there and buy a lot of these sectors that have not gotten much love. So they've been going into energies, they've been going into industrials, they've been going to financials, and they've also found some of those travel companies, like you mentioned, the airlines and the cruise lines, to purchase as well. And I think it's just an interesting rotation because they were actually sellers of communication services and IT, and then rotated into some of those sectors that have really been lagging behind the overall market.
Hey, Sean, it's Julia LaRoche. It's good to see you, even though from afar. Besides just the reopening, what are some of the other catalysts that you're seeing out there that's kind of driving these equity investors to pick up more of these names?
So I think by and large it is the reopenings, but the other thing, if you start looking at where else you can really put your cash to work with interest rates as low as they are right now, fixed income really is not an attractive place to put your money into. And we actually saw some lightening up on the bond front. So I do think right now it is sort of, so to speak, the only game in town. And that is, look, you can go put it somewhere, but you really are going to get next to nothing. Or you have some companies that are just extremely undervalued by some measures that they see opportunity in moving into now. And then I also think a little bit of this, especially over the past couple of weeks, was a little bit of people moving in who maybe missed out on the rally off of the lows. There's probably some short covering in there as well. All of that sort of coming together, and I think that's what's pushing equities higher.
Hey, it's Brian Chung. So a lot of people have been focused on tech just because it's such a big driver of equities here in the United States, at least. But the Russell 2000 has been on a tear too. I mean, people forget that it's actually been outperforming since the March 23rd lows. I'm wondering what you're seeing in small cap stocks and whether or not there's a play there or if the boat's already sailed.
So I think there is a little bit of a play there. And one is, as we have seen rates move higher, if you think about it, we had the 10-year above 90 bips just last week, and it's still staying at those elevated levels. I think that's helped out financials. And when you look at the Russell 2000, that is a big chunk of the Russell 2000 is some of those smaller regional banks. That's helped out. I think a lot of what we're getting in terms of government financial support and what we're getting from the Fed has also maybe taken some of that default risk off the table, and that's helped those small caps out quite a bit as well. And then also last week, and I know the jobs report on Friday as a whole we could talk for an hour on what was going on in that report. But if you look back to some of the earlier data points we got in the week, ISM, PMI, a lot of those actually showed a pretty significant recovery off of some of the low readings that we had in months past. So I think that also sort of gives you faith that maybe the US economy is starting to trickle back to life. And you're always going to see equities usually price things in 4 to 6 months before they happen. So I think right now the small cap stock is pricing in maybe a little bit of a recovery here domestically in the US economy.
Sean, want to talk about some of the specifics of what your clients were buying, among them Southwest, Walt Disney, General Electric, Wells Fargo, Norwegian Cruise Lines. Some people, that might be a head scratch. For instance, Walt Disney, we know they're going to try and start to reopen the theme parks next month, but is it still too early to try and take a position with these companies?
I don't think so. If you think about how low some of these companies really, dropped over the course of selling in March, April, and even a little bit in May, some of them still remain subdued. I don't think it really is too big of a head scratcher because the companies actually came out and were able to have some pretty decent earnings and provide a somewhat of a decent outlook. I think that investors thought maybe this selling was a little bit overdone. I think there's still going to be a little bit more of a wait and see now that you have seen some people move into those names to see how these reopenings go. Because I do think if you start to get some of these reopenings, you get a spike in cases and even worse, a resurgence of fatalities, then you could get things kind of the restrictions put right back in place. I think that would lead to selling in some of those names. But if we can actually get the recoveries to go smoothly and we start to see the easing of restrictions expand more and more, I think that actually can be another catalyst that can help names like Disney recover higher.
Sean Cruz is TD Ameritrade Trader Strategy Manager, joining us from Chicago, by the way, if you're ever at the corner of Broadway and Barry, the Bagel, great noodle pudding. It's Kugel. It's the best west of the Alleghenies. Thank you for being here, Sean.
I'll check it out. Thank you.
Well, we're going to be right back with more Yahoo Finance on the Move. We're going to check markets again as we go to break.
All right, chat. I think I'm going to end my stream here. Another good day in the markets. I'm going to take some profits later on today, I think. Depends on how it goes. We'll see. Hope you guys enjoyed the video.